Welcome back to Invest with Alex, the podcast where we take the mystery out of money, one episode at a time. I'm Alex, your guide through the world of investing, economics, and all those intimidating financial terms that seem to only make sense to the experts until now. Today's episode is all about the signals that shape the economy, the numbers that pop up in the news, shift the stock market, and often make people scratch their heads. GDP, CPI, unemployment rate, consumer confidence. What do they actually mean? And why should you, as an investor or just someone trying to make sense of the economy, care? Let's break it down. Think of GDP, gross domestic product, as the report card of a country's economy. It tells us the total value of all goods and services produced over a specific time period. Every pizza baked, every app coded, every pair of shoes sold, it's all part of GDP. When GDP is growing, the economy is healthy. Businesses are producing, jobs are being created, people are spending. When GDP shrinks, alarm bells go off. It often means less demand, lower income, and possibly a recession. As an investor, watching GDP helps you understand where we are in the economic cycle. Are we expanding, peaking, slowing down? Because different investments, like stocks, bonds, or real estate, perform better in different phases of the cycle. Next up, CPI, the Consumer Price Index. CPI measures the average change over time in the prices of a basket of goods and services. Think groceries, rent, gas, clothes, basically the cost of everyday living. So when you hear inflation is up 3%, that's usually based on the CPI. Rising CPI means your purchasing power is shrinking, you're paying more for the same stuff. And inflation affects everything: interest rates, company profits, bond yields, and even your savings account. Too much inflation. The Federal Reserve might raise interest rates, which can cool off the stock market. Too little inflation? That's a problem too. It can signal a sluggish economy. So watching CPI is like checking the pulse of consumer health. Now let's talk jobs. The unemployment rate is one of the most watched indicators out there. It shows the percentage of people actively seeking work but unable to find it. When unemployment is low, it usually means a strong economy. People have money, they spend it, businesses grow, and stocks tend to rise. But if unemployment is high, that's a warning sign. The job market is closely tied to economic confidence. And the stock market knows it. That's why employment reports released monthly by the Bureau of Labor Statistics can cause major market moves. Even wage growth, how fast salaries are rising, plays a role. If wages rise too fast, it can fuel inflation, bringing the Fed back into the picture. All right, we've covered the big three: GDP, CPI, and unemployment. But let's briefly touch on a few other important indicators worth keeping an eye on. 1. Consumer Confidence Index, CCI. This tells us how optimistic or pessimistic people are about the economy. High confidence? More spending. Low confidence? People hold back. 2. PMI Purchasing Managers Index. A survey that gauges the health of the manufacturing and services sectors. It's a great early signal for economic shifts. 3. Retail Sales. Tracks how much people are spending in stores and online. It's a direct look at consumer behavior, and that's what drives most of the U.S. economy. 4. Interest rates. Not exactly an indicator, but they interact with all of them. Rates up? Stocks may drop, but bonds might offer higher yields. Rates down? Growth investments tend to shine. You might be wondering, do I really need to track all this? Well, you don't have to become an economist, but being aware of these signals gives you context. Let's say GDP is slowing and unemployment is rising. Maybe that's a signal to become more cautious, shift some investments into safer areas like bonds or dividend-paying stocks. Or maybe CPI is rising fast and interest rates are going up. That might mean tech stocks take a hit, but banks and energy companies could thrive. In investing, context is everything, and economic indicators help you see the full picture. They don't give you perfect predictions, but they help you make smarter decisions. The economy is complex. It's always shifting, and sometimes the headlines feel like noise. But the more you understand these core indicators, GDP, CPI, unemployment, and the rest, the more the noise starts to make sense. You'll see what the markets are reacting to. You'll recognize patterns. You'll feel more confident making decisions. Whether you're investing in a stock, saving for retirement, or just trying to understand what's happening in the world. So the next time someone says, "The Fed's worried about CPI," or "GDP growth beat expectations," you won't tune out. You'll lean in because now you get it. Thanks for joining me today on Invest with Alex. If you found this episode helpful, share it with someone who's just starting their investing journey. And as always, stay curious, stay smart, and keep building your financial future.